Investing for Beginners Part 2. Welcome! Today we are going to learn about key financial indicators in the financial statements of companies that you need to know before you purchase a stock. Today we will learn the following. What is a P.E Ratio? What is market cap? What is a dividend? What is revenue? What is expenses? And what is a net income or net loss? Good day, afternoon, evening, wherever you are in the world today. The videos made for the channel are for educational and entertainment purposes only. First, what is a P.E ratio? A P.E ratio is a price to earnings, which is a way to measure how expensive a company's shares are by defining the share price or market value of a company's stock by its annual earnings per share. You end up with a figure that represents the amount of money you are paying for each dollar of its earnings. The average P.E ratio for the S&P 500 has historically ranged from 13 to 15. A side note, S&P 500 are the top 500 stocks in the US market. For example, a company with a current P.E ratio of 25, which is above the S&P's average, trades at 25 times earnings. The high multiple indicates that investors expect higher growth from the company compared to the overall market. So the higher the P.E ratio, the more expensive the company is perceived current value. But a lot of stocks with high price ratios are the bigger movers in the stock market. Investors see the chance for big gains into the future like Apple and Tesla have done in the last year. Next we'll look at market cap. What is a market cap? A market cap is the market value of a publicly traded company's outstanding shares. Market cap is equal to the share price multiplied by the number of shares outstanding. For example, a company with 20 million shares for the sale at $50 a share would have a market cap of $1 billion. Why is the market cap such an important concept? It allows investors to understand the relative size of one company versus another. Market cap measures what a company is worth on the open market as well as the market's perception of its future prospects. Because it reflects what investors are willing to pay for it, there are three caps. The large market cap stock is over $10 billion, which includes the likes of Amazon, Apple and Microsoft. Middle cap is between $2 billion and $10 billion, including Beyond Meat and Alaska Air Group. And small market cap companies between $300 million and $2 billion, including Tattoo Chef and Hawaiian Airlines. It is interesting that you can compare market caps in the same industry. McDonald's has 172 billion market cap compared to Domino's Pizza at 18 billion. But one thing about the Dominos is that they are continuing to grow at a faster rate than McDonald's, as McDonald's is already in most places around the world already, where Domino's is still building their brand. So there is more upside in Domino's than McDonald's at this current point. A dividend is a distribution of some of the company's earnings to a class of its shareholders as determined by the company's board of directors. Dividends are payments made by publicly listed companies as a reward to the investors for putting their money into their future. In the US, most dividends are cash dividends, which are cash payments made on a per share basis to investors. For instance, if a company pays a dividend of 20 cents per share, an investor who has 100 shares would receive $20 in cash throughout the year. Generally, dividends are paid quarterly, so 4 times a year, but sometimes they are paid monthly, biannually, or even once a year. Not all stocks include dividends. It is something nice to have to generate wealth over time, but generally growth stocks make more money over time. So a stock like Apple is ideal as it gives you both the dividend and the growth, and over time the dividend should raise quite considerably into the future. What is revenue? Revenue is the total amount of income generated by sales of goods or services related to the company's primary operations. Revenue, also known as gross sales, is often referred to as the top line because it sits at the top of the income statement. There's also interest revenue. This account records the interest earned on investments such as debt securities, which is also quite important to the company. But the main focus on revenue is what the company can bring through their service or products. The main idea for revenue is to make as much money for as little cost as possible. which leads to what is an expense. Expense is the cost of operations that a company incurs to generate revenue. As the popular saying goes, it costs money to make money. Common expenses include payments to suppliers, employees' wages, factory leases, and equipment depreciation. So basically any expense the company incurs to run their operation. The aim is to have more revenue than expenses. The difference between a net profit or a net loss. So what is net income? Net income is your business revenue after subtracting all operating, interest and tax expenses. To calculate net income or net loss, you must know your company's gross profit. Your business net income is known as a net loss if the numbers are negative, and a net income or profit if positive. How do you use net income in stocks? To me, consistency is key. A prime example of net loss improving would be Tesla Incorporated, a car electric company, battery and solar company, and so much more. From 2017 to 19, their net loss decreased every year from 2 billion net loss, as you can see on the screen, in 2017, dropped down considerably. By 2020, returned to profit. So a net loss isn't always a bad thing in a company if they are growing, but at some point they need to make a profit or otherwise they will go bankrupt. Companies with years of consistent positive net income can often at times be on sale due to not being an overly popular stock, as everyone chases the next big thing, whether it's GameStop, Tesla, Bitcoin, Dogecoin, go to Dogecoin, NFTs, and so much more. Those type of investments can be momentum investing, also known as following the trend, which becomes dangerous if you buy in at the top and the prices can often drop in half, costing people thousands of dollars. Nothing wrong with momentum investing, but the people that are successful are very low compared to value investing, where value investing is probably a more safer option, but you're more likely to make a profit with less risk compared to momentum investing, which I will make videos on both in the near future. I hope you have learnt a lot out of today's video and you can start to research companies that you like to invest into. I'm glad you came along today, and remember, here at Financial Guru we are forever learning in the share market, and I look forward to seeing you again. Peace out, my friends.